Hi, this is Stuart Weems and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And before I get started today, we have prepared a 97-point financial health check. 97 points, can you believe it? Anyway, you can download this for free. The link is in the show notes and it covers things like, how to select an investment grade asset. There's a checklist there, planning for retirement, property tax deductions, and lots more. So hopefully that's of interest. And I wanted to bring together, some of the points that I've been talking about in many of the episodes in this podcast in sort of checklist format. And hopefully you can run your eye down that and see if there's anything that you could benefit from. As always, I've got some really great listener questions to get into at the end of today's podcast. So if you've got any questions for me or even just some feedback, questions at investopoly.com.au, it'd be great to hear from you. Okay, so let's get into today's podcast, which I've sort of coined Liveinvesting, if you like. And it's really a blog I wrote back in late 2018, which is before this podcast existed, actually. So I didn't do a podcast on it. And I used, as I said, the term live investing. It's really inspired by the term rent investing, which is really where you rent where you want to live and then invest where it makes sense. So sort of turning that on its head, it's, instead of buying an investment property, why don't you consolidate and buy a much better home, which I've called live investing. And that's what I want to talk about today. And I think it's kind of timely given where interest rate settings are. That is, if we're not at the peak, we're very close to it. I mean, whether RBA hikes again, a lot of people are saying no, the market is saying no. So perhaps if we're forward looking over the next decade, interest rates are going to be lower than what they are today. And then the other thing is that there are certain capital cities, particularly Melbourne, for instance, that look relatively good value compared to sort of historic measures. And so maybe this strategy is, well, I guess the thesis I'm putting out there is I think this strategy has merit, particularly in today's environment. So then what is live investing? Well, live investing is really about investing more money in your family home to get into a better location that is then likely to generate stronger or higher levels of capital growth. And then as you get closer to retirement, the plan would then be to downsize your family home and pull out some of that equity and use it to supplement retirement savings. You might recall in a recent episode that was really aimed at helping people understand how much do you need to fund retirement. In that, I talked about having a perpetual portfolio, which means that you're really spending the investment earnings each year. And so in real terms, your net worth or investment assets don't deplete. And in that situation, you don't need to worry about longevity risk. That is, how long you're going to live for. You mathematically can live forever. And so in that episode, I worked out that if you want to spend $120,000 a year, which is, a pretty comfortable standard of living, of course, you need about $2.75 million in today's dollars. And so if you projected, for example, that you would have maybe $2 million in today's dollars by the time you get to retirement age, then perhaps in this situation, the remaining $1 million around could come from downsizing your home. And if that was your strategy, then the key sort of focuses on making that strategy work are, maximizing your super contributions and ensuring your super is wisely invested, so high returns, low fees. And then the second element is really just being able to manage the mortgage repayments between now and retirement, which might mean manage the mortgage repayments, might not necessarily mean repay a lot of debt, because the basis behind the strategy is that you're going to benefit from very strong capital growth and arguably stronger capital growth than if you hadn't have implemented the strategy. And that capital growth is going to be tax-free, of course, being the main resident CGT exemption. Now, in past episodes, I've talked about in a rising tide, all ships rise. And really, 30 years ago, you could have bought a property almost anywhere in Australia. And today, you'd have a substantial amount of equity in that asset. But as I've discussed in past episodes, property values in recent decades have been largely driven by an increase in borrowing capacity, particularly between the 1980s and, say, early 2000s, even up to 2010-ish. But really, since 2010, borrowing capacity has, in fact, contracted. And borrowing capacity, I think, if we look in future decades, we can't assume, or at least I think it's reasonable to assume, that borrowing capacity is not really going to change. Like, it's not going to increase like it did in that period of time between 1980 and 2010. And consequently, property growth is going to be dependent more on people's incomes, because that's higher incomes going to drive higher borrowing capacity. But if incomes are relatively stagnant, their borrowing capacity will be relatively stagnant. And then other areas, other geographical locations, because of the demographics, tax will be driven by other sources of wealth, such as inheritances and bonuses and those sorts of things. And that's why I've said previously, and still today, of course, I believe it is, that asset selection, the locality of your property, will matter more over the next 30 years than it has over the previous 30 years. And investing where the wealthiest 20% of Australians want to live, because the wealthiest 20% of Australians enjoy much higher income growth, higher than average. And because of wealth inequality, they're going to control more wealth in Australia. And if you want to invest and live in the localities where the top 20% want to invest and live. Now, of course, that's the financial aspect. But Liveinvesting offers other unique, advantages too that other investment strategies don't, where you're kind of merging the benefit of having a great family home and also a great investment property. And of course, that's a lot better than owning a home in an average location and owning an investment property in an average location. Merge the two and go put yourself in a much, much better location. Now, like every investment strategy, there's pros and cons, right? So let's be open to the positives and the potential negatives associated with Liveinvesting. So let's talk about them for a second. So let's talk about the potential benefits. So there's firstly, few things in life are tax exempt or tax free, but building equity in your home is one of them, obviously, thanks to the main resident exemption. So accumulating equity in your home is probably one of the most tax effective investments or ways to build wealth. The other benefit of Liveinvesting is you can, to some degree, put all your eggs in one basket. And by spending more on a property typically means getting into a better location and even a higher standard of dwelling. And, since quality is what's going to drive returns in the long run in really every asset class, you should then experience higher capital growth over time. So not only you've got more invested in that location, but the growth rate should be higher relative to an inferior location. And even a small differential in growth, 0.5% compounded over 30 years is a massive difference, and that can't be underestimated. Liveinvesting can have a massive impact on your lifestyle benefits as well. And it's something, of course, we give financial advice, and that's really aimed at maximizing wealth. The clients have to bring the family considerations. I can't deliberate on those. But for the clients where we've implemented this strategy, one of the big sort of feedback is, that it's really changed their life. Living near work, closer to shops, restaurants, other amenities, entertainment precincts, living in a sort of reputable public school zone, or even close to, revered private schools. All these things really have a positive impact on the property's growth, of course, but also on your lifestyle, your standard of living. And so in a way, it kind of ticks both boxes. You sort of say, well, it's great financially, and also it's great from our lifestyle perspective. And the final element is that, or observation, positive associated with Liveinvesting, is that it can make it a little bit easier to build your super balance. So of course, we're restricted on the amount of money we can contribute into super each year. So concessional contribution limit is $30,000 per year per person. However, if we're going to use a downsizer strategy, a Liveinvesting strategy, potentially we can move up to $1.5 million into super in a very short space of time after downsizing. Now, the way that you can do that is that each spouse has a non-concessional contribution limit of $120,000 per year. And so if you make one non-concessional contribution on 30 June, and then on 1st of July, potentially you can bring forward 3 years of non-concessional contributions. So that's really 4 times 120, which is 480. And each spouse can do that. Plus, there is also an additional eligibility around what's called a downsizer contribution. That's $300,000 per person. So put them all together, you're almost close to 1.6 into super in a relatively short period of time. So by investing in your home, it gives you, that's a tax-free environment, and then you sell or downsize that home, and then you move that wealth from a tax-free environment into another tax-free environment. And so from a taxation perspective, it's a very tax-effective strategy, except for the negative gearing, which I'm just about to go into. So let's talk about, they're all the good things. Let's talk about the negatives associated with Liveinvesting. And as I said, the first one is, and the most obvious one and most important one, is that home loan interest isn't tax deductible. You So if you're going to invest in your family home, you've then got higher non-tax deductible debt. That's very costly from a taxation perspective because I've got to use after-tax dollars to be able to repay that loan or at least even just service it. And I acknowledge that you're not going to pay capital gains tax on the home, but really the time value of money and a tax deduction is worth more to me today than, say, a tax saving in 30 years' time. And so it is a big negative associated with the strategy is giving rise to more non-tax deductible debt. But, no strategy is perfect, right? You've got to sort of balance it out and do the numbers. The other negative is, 5 years ago, it was really easy to set up a home loan as interest only on interest only repayments. And then the strategy in that situation would be, look, we're going to live in this asset for another 20 years. The kids will go to school. We'll enjoy living in this particular area. We'll enjoy the uplift in terms of capital growth. And even if we don't repay 1 cent of the loan principal, we're still going to walk away with a lot of money and we just need to service the interest cost. Unfortunately, today, interest-only home loans are really challenging to get and they're more costly, about 0.5% higher interest rate. So it's not particularly palatable. So if we're going to implement this strategy, it's probably have to make friends with making principal and interest repayments, which obviously are more expensive from a cash flow perspective. Now, of course, you're reducing debt. That's a good thing too. But just from an implementation perspective, a little bit harder to implement this strategy, say today, compared to when I originally wrote the blog in 2018. Another potential negative is that we're putting all our eggs in but one basket, and we call that in financial planning concentration risk. That is, if you buy an impaired asset, you make a mistake, you don't buy the right asset, the capital growth might not be as what you expect, or maybe there's some unforeseen factors that occur that are outside your control that impact the capital growth rate of the asset. And that's one of the negatives of putting all your eggs in one basket. If you don't get that growth, the strategy doesn't work. Now, of course, there's things that you can do to mitigate some of these risks, getting advice from a reputable buyer's agent, for example, that should help avoid making any really major costly mistakes. But the reality is that this strategy has a lot of concentration risk. Now, let's talk about the elephant in the room. The elephant in the room is, well, what happens if you get to retirement age and you don't actually want to downsize? Because I think this is probably the biggest risk associated with this strategy. I mean, the lack of negative gearing with the strategy, that's just a factual thing. In terms of the risk with the strategy, in terms of strategy not actually working, not wanting to downsize or not able to downsize, that's the risk. So let's think about why that might be. Well, you might not want to move to a different location. So you got to think about that. If your strategy involves, say, living in a capital city and then moving to a regional town, for example, and that's the only way that you're going to pull the equity out, you've really got to be absolutely certain that you're going to be okay with that. Maybe staying where you are, but say selling a 4-bedroom family home and moving into a 2-bedroom townhouse, maybe it doesn't crystallize the amount of equity that you think, you might need or in order to make the strategy work. Or maybe you're just emotionally attached to your house. Look, I think with respect to this risk, the best answer to it is just be really, really, really conservative with the numbers, as in overestimate what it might cost you to move to a smaller dwelling in order to crystallize some of that equity. And if you can implement the strategy so that you've got the flexibility to stay where you are, you don't have to move too far from where that dwelling is, that reduces the risk as well. If you do have to move somewhere substantially different, you just really need to be able to make friends with that. The downside of embarking on this strategy is that you might be forced to move to a location that you don't really otherwise want to. And you might think, I acknowledge that risk and I can kind of live with it. But I think with any strategy, we've got to think about, okay, what can go wrong? And if we can then make friends with that potential negative outcome, and then what we do is we implement the strategy to mitigate the risk of that potential negative outcome coming to the fore or coming to fruition. But if it does, we can always look back and go, well, I knew it could have been that, turn out this way. I don't regret embarking on the strategy because I knew that could have been the outcome. So I think it's really important then with this and all strategies, think about everything go wrong, make friends with that. And if you can make friends with that, then great, it's the strategy for you. So as I said at the beginning of the episode today, if you look at where prices are in some capital cities, so like prices in Melbourne, particularly Sydney, Canberra and Hobart, are rising at a much, much slower pace than other capital cities, with really Hobart and Melbourne being the outliers. In real terms, and we did the other numbers the other day, in real terms, since the start of 2020, Melbourne has gone backwards 2.4% per year. So that is in real terms, property prices are 10% lower than what they were at the beginning of 2020. And I say real terms, it's really growth less inflation, because inflation has been so high over that period of time. Actually, property prices relative to inflation have gone back. So another way to put it is Melbourne property is on sale, folks. Now, it's not going to be like that forever. I don't know what the impetus will be to sort of change it. Maybe a change in government, probably certainly a change in government is not only needed, but might spur on a recovery in the housing market. But the reality is, given the population growth, population size, and so forth, we will see a turnaround. And as I said, average interest rates are likely to be lower than what they are today. So that means if the strategy is affordable today from a borrowing capacity perspective and from a cash flow perspective, I think it gives us a lot of comfort that it's most likely, save for any change in personal circumstances, most likely to be affordable long term as well. Anyway, so that's live investing. I wanted to talk about it, particularly given the current situation in some states and current situation with interest rates, and something worth considering. Of course, there's pros and cons as I talked about it, and you need to balance all those out, but something worth thinking about. Okay, as promised, let's get into some questions. Okay, so the first question is from Paul, and it's about the use of annuities in retirement. And Paul asks, considering about 60% of earnings are recognised by Centrelink, is it wise to allocate super into an annuity to reduce assets for the Centrelink threshold? So what Paul is referring to there is what's called innovative retirement income streams, or IRIS is the acronym. If you just Google innovative retirement income streams, what you'll see is some of these income streams structured as annuities, which is you buy this investment, let's call it an investment, and it will pay you an annual amount of income each year. And if you buy these IRISs, only 60% of that is included in the asset test for Centrelink. So really, if you own your own home and you have a spouse, the asset test is around about $1 million, right? So if you've got, and that's for a partial pension. So if you've got somewhere between $500,000 or $1 million, or just a little bit more than $1 million, then you should get some advice, I think, from someone that's a Centrelink expert. That's not me or my firm, but someone that's a Centrelink expert on what you can do to structure yourself to maximize the age pension. But if you can have more than $1 million in terms of assets outside of the family home, so super and so forth, don't worry about it. You're probably never going to qualify for the age pension, and there's nothing you need to think about. So I'm not an expert in this area. I'm certainly aware of the products and their usage, but I think they have merit depending on your situation and really the net assets that you have. But as always, get independent financial advice. Okay, the next question is from Sean and Tanya, a really interesting one. And firstly, they've given me some lovely feedback about the podcast. And by the way, I should say it's really lovely to receive that feedback. As I keep saying, I'm very interested in the questions that I've been receiving. They've been really good. I wish I had have done it years ago, but also receiving the feedback's lovely to get. Anyway, Sean and Tanya, they say, I'm 58 and my wife's 56. We've been actively investing all our lives, mainly in real estate. We have been in the farming business for many years, and our farm has been our best investment. I believe it would be currently worth around the $5 million mark. Investments in commercial farming property is not something we see commented on very much. We've recently leased this property out for another 3 years, and there's no land tax to pay. Primary production land doesn't attract land tax. Sean and Tanya go on, why is there not more interest in this asset class generally, and what do you see as the advantages of continuing to hold it? So it's a really great question, investing in farming land. I was interested to see a bank, rural bank, put together what it calls the Australian Farmland Values Report. And over the last 10 years, farmland has tripled in value. So the compounding annual growth rate has been over 11.5% in farmland, people. So this is much higher than the average growth over the last 20 years, which was 8.4%. But let's think about the last 20 years is include the last 10 years, which is crazy. So if you looked at the longer term numbers, I don't have them, I think the compounding growth rate would be much less. So it's very clear over the last 10 years, we've had a massive increase in the value of farmland, well above the long-term average. Now, will it continue in that direction? One of the problems with rural land is it only has one use. You can't really do anything else other than lease it to a primary producer. And speaking to, some family members that are in in that sort of primary production industry, the money that you can make off that land isn't necessarily so great from year to year. It can jump around. So it's not particularly attractive. And it's not particularly attractive if that land costs you so much money as well, given the values have risen so much. And I don't think I'm going to stick my neck out too far by saying I don't think any asset is going to grow at 12% compounding for an extended period of time. Of course, that just can't continue. So if I was in your shoes, Sean and Tanya, I would be quite strategic about, what you might want to do with that particular asset. Now, will the bottom fall out of the market and will values plunge? I mean, it's possible. Land typically doesn't do that though. And I'm not an expert in farmland by any stretch of the imagination, but property values tend to sort of just hold themselves and then just move sideways for maybe another decade or two. But of course, it could fall. I think if I was in your situation and that asset is worth $5 million, and if that's a very large holding of your overall wealth, then to my mind, I wouldn't be able to stomach that concentration risk. And after 12% compounding annual growth, I would take the money off the table. And taking a profit, you should never be too scared to take a profit. At some point, and particularly if you get into retirement, you just don't have the runway anymore to ride out a cycle. And if you've had a cycle of 12% compounding return for the last 10 years, the next cycle could be pretty flat for another 20, or maybe it will fall in value. Who knows? To answer the question, why don't we talk more about farmland as an investment? Well, I think reflecting on it, there's probably a couple of things. Firstly, proximity. With residential properties in our face, the share market is in our face for those that live in capital cities. We're not really going to think about farmland. Of course, knowledge is a big element too. Where do we know which bits to buy, when to buy them, all those sorts of things. And then cost as well. You're going to pay probably $5,000 to $10,000 per hectare. A small farm would be 100 hectares. Okay, that's relatively affordable, but there's a lot of holdings. I think I saw that the average holding for farmland is more than 4,000 hectares. So I guess the entry point, in your case, Sean and Tanya, $5 million. A lot of people aren't going to go, well, that's a great investment. I'm going to put $5 million into that asset. I have some family members, a cousin that has done incredibly well out of investing in farmland, but that's not their only asset. They've got a diversified portfolio, of course. Next question is from Andrew, and a bit more of the usual questions. Probably first time I've talked about farmland for at least 10 plus years. Anyway, Andrew writes, thank you very much for your interesting, informative episode 313, which is about indexing strategies. Further to that episode, what's your view with respect to listed investment companies, LICs? Do you prefer ETFs to LICs? Why and why not? Thank you very much. Okay, easy one to answer, Andrew, but a really good question. It's true, I actually haven't mentioned LICs, and it was remiss of me not to. Let me put it this way. I would rather stick pins in my eyes than put money into an LIC. There's three predominant reasons for that. Firstly, listed investment companies, LICs, actively managed products. Not always, but typically. Active management means that the fund manager that runs the listed investment company picks which stocks to invest in. They don't invest in the index. And if you look at the data, particularly in Australia, the data is consistent everywhere else, but 85.37% of all active fund managers underperformed the index over the last 15 years. So that means 15% outperformed the index, but the problem is it's not the same 15%. So the persistence of outperformance almost never lasts more than 2 to 3 years. So that means if you want to pick the top 15%, you've got to pick which fund manager you invest in today, and arguably you've got to sell that in 12 months' time and move to the next winning fund manager. Just really unlikely. If you have a look at the largest LIC in Australia, which is AFIC, AFIC, it's underperformed the index by 2.4% over the past 10 years, which is terrible performance, right? So performance is number one. And as I always talk about, an evidence-based approach. So my argument to anyone that likes LICs is show me the evidence they're going to work consistently. The second reason is that they tend to either trade at a premium or discount to NTA. NTA stands for net tangible assets. The net tangible assets is the value of the portfolio, which means that a listed investment company could hold a portfolio of Australian listed stocks that on the market is worth $200 million, but that LIC might be trading at $220 million. That means it's trading at a premium to NTA. I'm overpaying for those assets. Why would I do that? Other times when the market doesn't believe that the fund manager is any good, that they're going to deliver good returns, or that maybe they've overpaid for investments, might be trading at a discount to NTA, which means might seem attractive because you're getting a bit of a bargain, but the problem is that that discount might persist forever, and with some of them it does. They're trading at 80% of NTA and they never recover, right? So what you really want is to make an investment in the underlying asset. So if I'm going to invest in the ASX 200, I want my performance to match the ASX 200. The problem with LICs is the reputation and the strategy of the fund manager get in the way of that. And if the market doesn't like it, you'll be at a discount. If the market is too excited about it, then it's going to be traded at a premium and you're going to overpay for the LIC. And lastly, fees. So some ETFs, charge 0.05%, which is virtually nothing. Most LICs are going to be close to 1% or more. Often there's a lot that charge 2%, for example, in terms of fees. And that might explain why the performance is so poor in terms of underperforming the index. Part of that will be the fees element. Part of it will be turnover. Part of it will be tax consequences. There's lots of reasons why active fund managers fail to beat the index. So Andrew, no to LICs, but fantastic question. And I really should have covered that off in that particular episode. Okay, today's final question is from Danielle. It's a really long question. Let me sort of summarize it. Danielle's asking, how much should they be paying for their rental expense? They earn sort of decent income. They inherited some land that they will build on, but it's really around, what is the most economical amount of rent to pay? It's kind of an interesting question because, part of it is a lifestyle consideration. So in this podcast, I can only ever give you, what I think is financially prudent. Of course, there's a lot of lifestyle considerations in many of the things that I talk about, and that's the kind of overlay that you need to provide. Danielle didn't tell me her income, so I can't really compare it to the expense to income. But to my mind, if you're spending more than, say, 25 to 30% of your net income on your rental expense, it's okay to spend more of that on if you've got home loan repayments because you're owning the asset. But I think if you're spending more than 25 to 30% of your net income after tax, then I would say you're probably living beyond your means, which means that you're living in a property that's probably too expensive relative to your income. Actually, Danielle does say that they're living in a really large house and they don't even use some of the bedrooms. So look, I think with financial planning and cash flow management, the key is to get the most utility per dollar spent. Utility means enjoyment or benefit or outcome, right? And I often use the analogy or the example of holidays. We think very deeply about holidays. We get a lot of enjoyment from them. If we didn't take them, standard of living would suffer. So per dollar, we get, even though holidays are expensive, of course, per dollar, we get a lot of enjoyment. But if I go and make a whimsical decision to buy a takeaway coffee, which I don't do often, by the way, but if I did, whether I had that coffee or not, at the end of the day, it's probably never going to change my day. I'm never going to think about it again. It's a whimsical decision. My utility per dollar for that coffee is very low. So with anything in life, it's just about, with cash flow management, I should say, in life too, I guess, it's just about maximizing the utility per dollar spent. And for some people, they're going to spend a lot on one particular thing. And I might, for instance, go, I wouldn't get any value from that. That's okay. It's your life, it's your money. You've got to enjoy the time while you're here. You've got to build wealth too. So I would say that if you're in a big house and you're not using some of those bedrooms and it doesn't change your life, of course, downsize and save some money on rent. Okay, so I'm conscious of time. That's it for today. Thank you so much for listening. If you have questions, send them to me at questions@investopoly.com.au. Just a reminder, as I said at the beginning, we've got that checklist. The link is in the show notes. 97 points to run your eyes down to see if there's anything that you can do to improve your situation. And until next week, bye for now.